Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning and welcome to Fed Day. This is Peter Lewis with Money Talk on Thursday the 15th of June. Thank you for listening to my podcast and making Money Talk one of the most listened to financial podcasts in Hong Kong on Apple Podcasts. You'll also find the show on Google Podcasts and Spotify. This is the original Money Talk, and this podcast is sponsored by Surfin Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, the Federal Reserve held its benchmark interest rate steady for the first time in more than a year, following 10 consecutive increases, but signalled its intention to implement further increases this year. In a unanimous decision of the Federal Open Market Committee, the federal funds rate was left unchanged at the existing target range of between 5% and 5.25%. It's the first time the FOMC has refrained from raising rates since the current hiking cycle began in March 2022. However, in an updated dot plot accompanying the statement that collates policymakers' forecasts for the Fed funds rate until the end of 2025, 2 more quarter-point increases this year are expected by members of the FOMC, according to their median projection. After months of disappointing data, economists expect the Chinese government today to cut the headline policy interest rates for the first time in almost a year. Chinese state media is signalling the PBOC will take further monetary easing measures by cutting the medium-term lending facility rate by 5 to 10 basis points today. Bloomberg News is reporting that senior Chinese officials are soliciting advice from business leaders and economists on how to revitalise the economy. Top officials have held at least 6 consultations in recent weeks with business executives. Leaders pressed those assembled for ideas on ways to stimulate the economy, restore confidence in the private sector, and revive the real estate industry. US Secretary of State Antony Blinken will visit China early next week as part of the American effort to improve ties with Beijing. Mr. Blinken will be in China on June the 18th and 19th. A key aim is to establish communication channels that are open and empowered, the US top diplomat on East Asia, Daniel Crittenbrink, said Wednesday. On today's programme, I'm joined by Andrew Freris, the CEO of Ecognosis Advisory, and James Wong, Chief Executive Officer at Cathaysia Securities. With a view from Taiwan is Ross Feingold, Business Development Director at SafePro Group.
Peter Lewis's Money Talk.
Following a hawkish tone from the Fed, which paused on interest rate rises today, but signalled at least 2 more rate increases before the end of 2023, the S&P 500 declined immediately after the decision. The dollar paired declines against a basket of currencies, and yields on 2-year treasuries surged to the highest since March. However, as Jerome Powell was speaking at the media conference following the FOMC meeting, the S&P 500 recovered all of the lost ground to close in positive territory, and the rise in yields unwound. Mr. Powell appeared to downplay the dot plot, which projected 2 more rate rises this year, saying no decision has been made for the next few meetings, which encouraged investors and caused wild swings across several asset classes. By the end of the session, the S&P 500 had eked out a narrow gain, rising 0.1% to close at 4,373. The Nasdaq Composite added 0.4% to close at 13,626. During the session, both the S&P 500 and the Nasdaq touched their highest levels since April 2022. The Dow dipped 0.7% or 233 points to end the day at 33,979, and the S&P 500 is up more than 13% this year and more than 25% from its bear market low last October, as investors bet the Fed will soon stop hiking rates. The Fed next meets July the 25th to the 26th. The yield on the 2-year note hit a high of 4.8% before ending the day unchanged at 4.69%. Hong Kong's Hang Seng Index opened 0.2% higher, but gave up those gains to end the day 113 points, or 0.6% lower, at 19,408. The Hang Seng Tech Index rose 0.4%. On the mainland, the Shanghai Composite was 0.1% lower at 3,229. Futures markets are pointing to a gain of 210 points, or 1.1% at the open today. And you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com, which has a lot more business and finance information from across Asia.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's welcome our Fed Day guests. We have with us in London Andrew Freris, the CEO of Ecognosis Advisory. Morning to you, Andrew.
Good morning.
And also with us is James Wong, who's Chief Executive Officer at Cathaysia Securities here in Hong Kong. Morning, James.
Good morning, Peter.
Well, as you heard there, the Fed has left interest rates on hold, but has signalled that there's going to be some further increases this year. Let me start with you, Andrew, and just first of all get your sort of main takeaways from what the Fed did and said.
Well, perhaps not surprisingly, they took a breather, and then not surprisingly at all, they're signaling an extra quarter of 1% increases in the months to come. Real rate of interest right now, of course, it is being squeezed as inflation has come down very quickly. Let's not forget, I prefer to look, I know the Fed looks at the PCE, I prefer to look at the CPI. Okay, it's much more eye-catching for my taste. And in February, it stood at 6%. Now in May, it's down to 4%, 200 basis points decline. And that means that real interest rates are now on the positive side. In other words, the Fed is charging between 5 and 5.25, and the rate of inflation is 4%. So real interest rates, in a sense, over the rate of inflation by more than 1%. And that's quite important if the rates are supposed to bite on anything.
So are they in restrictive territory?
It's a really different issue. But it simply confirmed my rather bored expectations.
So, Andrew, are they in restrictive territory now, interest rates, at this sort of level, where they're going to start sort of holding back the economy?
Well, if I was to take the CPI rate of decline, I'm surprised that the markets have not been quite satisfied, because, my God, that's quite steep. 6, 5, then sort of 5 again, 4.9, and then 4 down. Wow. That's not doing too badly. And in fact, the individual components were also spread quite widely, whereas the CPI actually increased rather than fall during not a similar time between April and March.
Mm. So, James, did the Fed do the right thing?
Oh, it's really hard to tell. I mean, I think a lot of people are going to have different opinions on this rate decision, although it's a decision that many of us has already expected. About 3 to 4 weeks ago, when Kashkali, one of the leading voice of the Hawks, stated the term skip for the first time, and basically implying that he supported a skip in June. And then before the Fed, I think 2 weeks ago, before the Friday of 2 weeks ago, we saw about 6 Fed officials coming out and saying different things about a Fed decision, a rate decision in June, and about half of them stated that they want the rate to rise in June, and the other half said they wanted to, or they implied they wanted a rate pause in June, and but among those who said they wanted the rate to be paused is James Bullard, one of the most hawkish Fed official there is, and so we didn't really expect anything else than a skip in June. But the thing that you asked is if Fed has made the right choice in here. I really couldn't tell. I just think if we are looking at core PCE and core CPI, those are still very sticky. If we just look at the CPI numbers that was announced on Wednesday night, it was still, I think everybody can get something out of there. If you're dovish, if you're hawkish, you can say you can see different things, different components in that set of data. And I think the only reason that Fed decided to skip in June is because they've found that financial conditions has been tightened enough for them to have not as much needs to raise rates in a short time frame. Still, well, I think the way that the service price that is being on the rise, especially in the PCE, core PCE. I just don't see how Fed could have enough maneuver space to really reduce or change the direction of the monetary policy anytime soon.
And Andrew, the thing that Jerome Powell in his press conference really emphasized, I suppose the message that he stuck to most of all, was that inflation still remains too high and interest rates may yet go higher. This isn't, he didn't like to use the word skip, but he made it very clear that, interest rates were likely to go higher. Do you think investors are getting that message at last?
Quite likely, actually. Bless his little heart and his little boots. The 2% target hasn't changed. So, in other words, if I'm looking with a weary eye over my numbers, and we are still at 4% inflation, and the Fed targets 2%, and incidentally, targets 2%, it goes there and then it stays there. It's not that it hits, and then if it bounces back again, we'll say, well, we achieved the target, never mind. Okay, then still we have 200 basis points of inflation to leak between the 4% and the 2% they're looking at. And I doubt that we're going to see such a spectacular decline, 6, 5, 4, and then 3 and 2. In 2 months we are at hitting the target. I don't think this is this is going to happen. So the answer is yes, they mean the 2%, and yes, they will try to hit it in one way or another, keeping in mind all the time that increases in rates always have a lag, sometimes as much as 6%, so it's as much as 6 months in hitting their targets, and that is spending and therefore inflation.
Do you think there's going to be more of a debate going on soon as the Fed, when you look at all these Fed inflation forecasts, do you think there's going to be a debate around changing the Fed's inflation target? Is that debate going to gain traction? I mean, I noticed Mohamed El-Erian was signalling that a couple of days ago.
Yeah, unfortunately, I'm going to give you an unbelievably boring answer to that, because if you look at a sprinkling of numbers like new jobs creation, which has been coming down, the rate of unemployment, which is expected to go up. So if any of these things in the next 2 months begin going south, then we're going to have again the same thing. Did they do too much too soon? Okay, I don't think this is going to be the case, and I suspect they would prefer to be mistaken on the tougher side rather than on the weaker side.
It's a choice of policy errors, isn't it? Which one is the worst? Is it by leaving things and seeing inflation rip higher, or is it by tightening and then tipping the economy into recession?
Absolutely. Sorry, I'm simply repeating what the Fed tells me. Okay, and that is they want 2%. They want 2%, and I don't have any reason to doubt that they will try to hit the 2%. And in between, there's going to be a lot of noise. Okay, a lot of lack from numbers that are pointing southwards, and therefore urging them to reconsider. And I don't think they will do the same mistake they did before, which was on the other side. Okay, they took too long to start tightening.
James, the reason why I'm asking about investors, whether they're getting the message, is because, as you remember earlier this year, they certainly weren't. In terms of rate cuts, investors were calling for about 100 basis points of rate cuts earlier this year, even though the Fed was saying, nope, that's not going to happen. And there's still this disconnect, because now the dot plot is basically saying 2 more rate rises this year, that's another 50 basis points increase, whereas the market is basically saying, no, we're not going to see that. At most, we might get just 10 basis points, which is half an interest rate increase. So investors are still sort of fighting the Fed, aren't they?
Well, they have been fighting the Fed since the second half of last year, and we've already seen how that actually affects on the market. It's not really that pretty. And I think back in last year, the widest gap between investors' terminal rate expectation and the dot plot median is about 160 points, 160 bips. So that was a wide gap, but that gap has been narrowed in the past half year, and it's been narrowed towards the direction that the dot plots indicated. So I think market kind of gave in since last November, and then we've seen the rates moved in the direction that Fed already always insisted. That is more hawkish. And I think the way that the market and the Fed interact is getting a little more easier to understand and to predict. The Fed is gonna insist that the rate is gonna stay high for longer, and the market kind of gets the blink here and there to as to whether the one single meeting is gonna result in the rates. So I think both the markets and the Fed are now kind of comfortable in the way that they interact, and I definitely think the market gets the idea of the Fed of what Fed was trying to imply every time before the meeting. And to answer your previous question as to whether Fed is going to change the 2% inflation target, Jay Powell was actually asked this question last year, and he gave two versions of answers. First, he said there was absolutely no possibility that he's going to change the 2% target, and then he followed that statement by saying there might be a chance for him to discuss the possibility of making the 2% target a different one from 2025 onward. So even if the Fed is to change the target inflation rate, we will still need to wait about 2 years or more.
So Andrew, a lot of Jerome Powell's press conference was taken up with him talking about can he get to this inflation target without causing a recession? Is there a path to not having a hard landing? He was talking a lot about employment as well, saying that this is very much tied in to the employment market, and the employment market is still very tight. So what do you think? Do you agree with that, first of all? Do you think the future now for rate hikes depends upon the labour market, and can he get this down to the target without causing a recession?
Well, first, deep breath. The word recession is grotesquely overused. I absolutely refuse to be concerned in the slightest about it, because if we're going to take that unbelievably trite definition, that's 2 back-to-back quarters of negative GDP growth on a quarter basis, annualized, whatever that means. Again, I don't think we're going to see it. So if one says about risks of a recession, they have to, I imagine, simultaneously give their definition of what is a recession. And the GDP growth has been increased for next year from 0.4 to 1. Let's say it varies now between 0.5 percentage point and 1%, which is not exactly great. So we're not exactly going to decline from, let's say, 2.5, suddenly we're going to go down to 0. In other words, we're playing around a flat number. And the answer is yes, inflation and employment are going to be two key criteria, and backwards how they affect the rate of increases in wages. But labor numbers in the States are notoriously fickle, okay, and notoriously changeable. So I'm not saying that they are misleading. They will need to have, let's say, at least a 6-month rosary, if I may permitted the expression, of prayer beads, okay, of the unemployment going up and job creation coming down before they say, oops, we're overdoing it. So no, I don't really think that they are going to change their inflation target. Ta-da!
Okay, interesting. We'll see. James, what about the market reaction to all of this and where the markets go from here? It was quite a volatile day in treasuries, in the US dollar, in stocks. But if, as you know, we've seen this big rally in technology stocks, which is sort of partly because of this fear, isn't it, that the Fed was going to cause a recession, and those high growth stocks were sort of insulation from a recession. But if the markets are now getting more comfortable with where the Fed is and believe that there's going to be a soft landing, we're not going to go into a recession, does that change the market outlook? Because maybe you don't need to be in these high growth stocks anymore. You can start looking at value stocks, small caps, those which benefit from, a steadily growing economy.
Well, no, not at this moment. I don't think any fund managers or money managers have the guts to invest not into those 50 biggest mega cap stocks listed in NASDAQ or the 7 most large cap companies in NASDAQ, in Standard & Poor's. And the reason is if some of these money managers have made previous arrangements preparing for a recession. They increased their weights of stocks in defensive sectors, and they decreased their stocks holdings in the cyclical sectors, and that resulted in a high opportunity cost and low return for the year, for the first about 3 months of the year. So they've learned their lessons, and they know that apart from the fourth industrial revolution, like ChatGPT linked generative AI concepts, they really don't have anything else that they could really invest and have everybody else investing in. So that's really the problem of the U.S. equity market right now. It's too crowded. But again, it's not the first time that U.S. equity is becoming crowded. But this time, the only concern that I have is, granted, I think ChatGPT is going to be the really big thing, the thing that increased productivity, thus the driving force behind the fourth industrial revolution. But even a creative destruction couldn't really harbor from a downward economic trend. I'm thinking we've already seen the orders that NVIDIA has been taken. It's tremendous. I mean TikTok itself placed about $1 billion of orders to NVIDIA, and we've seen the NVIDIA have given us very optimistic guidance for the second and third quarter, but I'm not so sure about the fourth quarter. My question is, if the overall economic trend is going downwards, and even if companies are thinking if they have the need to spend money on ChatGPT or to train their own bots, wouldn't that be reasonable for them to wait a little if they have no more money to spend because of the downward economic trend? That's my question.
Okay. Now I want to turn our attention to out here. Andrew, we had a surprise cut in the 7-day reverse repurchase rate earlier this week by 10 basis points, and it looks like the PBOC is going to take further monetary easing measures today, cutting the medium-term lending facility by 5 to 10 basis points today. What are these small sort of cuts, which are obviously going in the opposite direction to what other central banks are doing, but what are these small cuts doing? Are they significant? Are they going to make any difference?
The answer is no. They are not going to make a significant difference, and also they are very much par for the course, and they very much reflect the way in which the PBOC manages interest rates. For example, the 1-year rate was cut in about early 2020, and then nothing happened to it till early 2022. Okay, in between we had the COVID, we had everything else you want to pile in, and nothing has happened. Then during 22, it was cut by tiny amounts twice, and then nothing. All right, so if I was to take the 22 till now, about a year and a half, not a great deal of action, and undoubtedly they're going to cut it because they have already cut the 7-day reverse purchase. Frankly, 10% basis points is very little. But having said that, God, I sound like an economist. How horrible. Okay, with inflation in China being less than 1%, yeah, we are still talking about real interest rates being reduced, even if they're in tiny amounts. But then that's what the economy has. You know, if you have 1% inflation and you have 1% interest rates, you have zero real interest rates. Well, you're doing quite well. So I have to be a little bit more charitable than saying, "Come on, give me a break." 10 basis points, seriously, as the Americans say. Yeah.
So is this really more of a sort of a signalling sort of effort? Really, it's the central bank saying, "Look, we're in easing mode. We're going to lend more support to the economy," and they're just trying to use that signalling power rather than they know there's not going to be much of a practical effect of these rate cuts.
Yeah, and also I'm still working my way through the 22 measures they threw at us last Tuesday. Okay, that's quite interesting. And the fact that they're not supporting at all, they haven't tried to support at all the foreign exchange rate. Okay, that has come down from the 6s to the 7s very, very neatly and sustainably high. In other words, clearly the PBOC doesn't mind seeing the exchange rate weakening. Mm-hmm. Which is it's good for their exports. Well, yeah, except I'm not quite sure whether we're talking about an elasticity of demand for Chinese exports vis-a-vis its price, as opposed to the overall, let's say, global demand, which is two separate things.
James, what do you make of these rate cuts, both the one that we've had and also the one potentially coming today, which will be just ahead of some important economic data as well? We've got retail sales, fixed asset investment, industrial production numbers, all coming out today. What difference is this going to make to the economy?
Yeah, it's a scary day to see all those numbers coming out because based on our past experience, these numbers won't be pretty. And I think the reason that the Chinese or the Greater China area stock market was on the rise since the Friday before is because when the Fed officials made statements about having the interest rate paused in June, and then people think, okay, there will be no more rate differentials between the U.S. and China because of what U.S. is doing. So the PBOC has a lot more room to do whatever they need to do on monetary policy to help boosting economies. And I think it's been this is a series of open market operations that they've already been doing, the extension of open market operations, and they lowered. Apart from OMOs, they've lowered the lending rates and the saving rates, and now the LMFs. And I'm pretty sure they're going to lower the 1 year and 5 year LPR as well. And but I don't think these are enough. And along with all the rumors about the stimulus packages that they were preparing to launch, and some of them are already official, but I still don't think those are enough. So, for example, the tax benefits for NEVs. Now they decided 2 weeks ago that they will extend these tax benefits for another 4 years after 2023, and these are really not stimulus at all. I mean, if I don't really buy an EV this year, I can buy that next year. If I don't buy it next year, I can buy the year after because the tax benefits are always going to be there. So I don't think any rumors or any policies that really landed at this point have any practical effects on stimulating the economy. I think there are going to be more and more policies going to be focused on how to boost the real estate sales.
Mm. So, Andrew, if the problems facing China, if they're not going to be resolved by incremental sort of easing rate cuts like we're seeing, what do policymakers need to do to try and support the economy? They're clearly very concerned. Bloomberg is reporting that Chinese officials are meeting with business leaders and economists, asking them for their ideas. What would you say to them?
Well, we have a very delicate issue of political economy here, in the sense that when it came to pass that a very important policy decision had to be made, and that was over COVID, okay, they really came down with a whack. And then, guess what? They reversed it overnight without blinking an eyelid. So I am sure this has taught them two things. Possibly only one thing, although I don't believe people ever learn anything at all. But never mind. I suspect that they don't want to take very sharp policy measures now, and they will prefer possibly to risk a weak economy for 2 years rather than do that and then having to do again another COVID. In other words, a sharp reversal. Okay, and in that sense, and if I was asked, which I wouldn't, and I wouldn't want to do that, my advice point of view, it will be that they will need to continue easy as it goes, knowing fully well that this is not going to work. It is not going to work quickly, okay, rather than at all. But for them to do something really quite dramatic, I suspect the COVID yes, no, okay, or rather no and then yes, okay, is too fresh in policy-making minds. Remember, COVID was a very man-made policy. It has nothing to do with mathematics, electronics, or even, as it turns out to be, not even medicine. Okay, it was purely a political decision.
So it sounds like from what you're saying, really the priority for the Chinese government is not boosting growth. That's not what they're trying to do here. What they're trying to do is restructure the economy.
It is interesting that all the murmuring gossip that comes out of the meetings is of business saying, leave the market alone, let the private sector do the running, less central planning. And of course, let's not forget, COVID was a par excellence central planning. I mean, it cannot have been more than central planning. Okay. So I'm not quite sure whether this is a murmured criticism of, don't let us do it rather than you trying to do it again. Whatever it is they do, the it parties.
James, let me ask you what this means for Hong Kong stocks. Hong Kong equities, historically, they've done quite well when the Fed starts to pause a tightening cycle. Obviously, it remains to be seen whether there's a pause for very long here. And also, we've got the Chinese central bank cutting key rates. Is this going to provide a boost at all, do you think, to Hong Kong stocks, or maybe put a floor under them?
Yeah, I think the latter. It's going to put a floor under the Hong Kong equity performance, especially the index performance, because before we were thinking about two scripts that the Hong Kong equity could be going towards after Fed implied that there will be no raise in June, and one of them being the investors start to trade up, and based on the hopes that there will be more stimulus packages coming out, and the other being the investors patiently wait until all stimulus packages are landed, and then the economic data are still showing some strength. And I think we are going at this point with the first script. And so as long as these stimulus packages or policies are not landed, I think we are safe. But as soon as all the rumored stimulus packages are landed, I think there will be a sell effect.
Okay, well, thank you both very much for your thoughts there. Two important topics going on today. You heard James Wong, Chief Executive Officer at Cathaysia Securities, and Andrew Freris, who is the CEO of Ecognosis Advisory. I'm joined now by Ross Feingold, who is Business Development Director at SafePro Group over in Taiwan. Morning to you, Ross.
Good morning.
Now, US Secretary of State Antony Blinken, his long-hoped-for visit to China, looks like it's going to be on. Mr. Blinken's going to be in China on June the 18th and 19th. This was the visit that was initially scrapped back in February after that suspected Chinese spy balloon flew over the United States. Washington's been keen to reschedule the trip. Is this a good sign, Ross, of maybe some thawing in relations between the two?
I suppose it depends on one's perspective. It was definitely a long hoped-for trip by the Biden administration. As you mentioned, it was previously planned for in February, but it seems that the one hallmark of Biden administration foreign policy is they want dialogue. They want dialogue with China. They want dialogue with Iran over its nuclear weapons program. They always want this dialogue. Sometimes it seems like they want the dialogue just for the sake they have dialogue, and that's an achievement in itself. And then they always throw in a lot of buzzwords about managing competition responsibly, but still have cooperation in some areas, et cetera, et cetera. And I think we saw a lot of that in recent hours with the statements after the phone call with Qinggang and then the statement announcing the visit. But you mentioned another key point, which is if he's only going to be in Beijing for 2 days, one night, it might seem like 2 days of meetings, but that's actually not going to really be 2 full days of meetings, plus he'll spend a bunch of time with the embassy staff. How much substantive time are they going to talk? The two sides, Blinken with his counterparts from the Chinese government, maybe 5-6 hours at most it talks, and they're going to cover this wide range of issues, which is going to be things like Ukraine, things like Iran, North Korea, and then Blinken will state the U.S. positions on some of the more sensitive issues like related to trade, human rights, democracy, and of course Taiwan. I'm saying all of this by way of also saying we should have no expectations of any big news coming out of this meeting.
So you don't think anything really can be resolved at the end of this, although we'll have the talks, the substantive issues between the two sides. They're so far apart. I suppose it's hard to see how anything can be resolved.
Maybe coming out of this, they'll restart some of the bilateral dialogue mechanisms that were stopped by China last August when Nancy Pelosi visited Taiwan, and some of those issues were illegal entry and return of people who have entered the United States illegally, dialogue on drugs, environment, things like that. Obviously, the United States side they're not going to give away anything on issues like Taiwan. They're not going to stop criticizing policy changes in Hong Kong that have been implemented by the Hong Kong or the central government. So we shouldn't have high expectations. But one thing is certain is there's going to be a lot of criticism in the United States. For example, Republicans in Congress, scholars outside of government who argue for a tougher line on China. They're going to say the timing is not right. There's been these recent incidents, like in the Navy ship incident in the Taiwan Strait recently, among other things, and they're going to say that it's kind of like you're giving in too much to China just by going there. So there's really two different views on this trip and on whether or not dialogue should be going on. The US view is that it's important to keep the lines of communications open because that could help avoid an accident in the South China Sea or something like that. China's point of view on this seems to be that dialogue is pointless unless it's with a particular purpose and with an aim of actually changing something. But there's no point talking, but then carrying on doing all the things that you're doing either behind the scenes or at the front of the scenes. So who do you think's right? Again, it's diplomacy. So we'd like to say everybody is right, but actually maybe everyone's wrong. But I think the way you asked your question, that actually is going to help the critics, because the critics are going to, again, in the United States, they're going to say that, in our view, here's a bunch of things that China is doing, a bunch of bad behavior, and you're still going there, and you extracted beforehand. You got nothing from China, and you're kind of rewarding them with the Secretary of State visit. Why? Well, why is it so urgent that you go there just to say that you went there? And we'll probably hear more of the Beijing Biden accusations that Biden or Blinken are on the payroll of China as well.
So it's not going to change anything, is it? Because Washington's blacklisted, more than 1,000 companies and entities on multiple grounds now for human rights concerns, for ties to the military, the use of technology and so on. Presumably none of that is going to change, are they? Anthony Blinken's not going to come away from that thinking, maybe it's time to ease some of those sanctions.
Well, once these things are implemented, once a company is on a list or once a tariff has been raised, it's very, politically, it's very difficult to undo that. And of course, it involves interagency input as well. It's not only up to Secretary Blinken, many of these things. But I would generally agree with you that coming out of this trip, Blinken's not going to announce that a bunch of companies have come off, or if he does, it's going to become the smallest companies on the list that arguably shouldn't have been there to begin with. But when we think about sanctions on products that come from Xinjiang, for example, again, once these things are implemented, very, very difficult politically to undo it.
And
you could add to that list. I was just saying, you could add to that list, this this question that's gotten a lot of media attention in recent days, and that's whether or not Chief Executive John Lee could attend the APEC meeting in the United States later this year.
I'll come on to that in just a moment. I mean, let me ask you about these sanctions. I mean, we've had the Trump sanctions now, haven't we, in place for about 5 years? And as you say, once they're on, they never seem to come off. But presumably there will be an easy win there. Some of those sanctions were pretty pointless. They're on companies that have no relation to defence or national security issues. There could be a token gesture, couldn't there, of at least maybe removing some of these tariffs and then China removes some of its tariffs back?
Yeah, I mean, on the trade side, and specifically the tariffs, I don't see the appetite there at the moment for the Biden administration to do that, keeping in mind he talked about it when he ran for president, and once he became president, there was a big to-do about a China trade policy review. Then it was announced, and it was actually pretty much nothing other than to say we're going to continue the tariffs. So they haven't done it by now. You know, that doesn't look like they're going to lower tariffs on companies that are on these various blacklists of the United States. Again, you could probably find a company that's not that important, not a major player in its industry. Maybe it shouldn't have been on the list to begin with as well. But when it comes to the larger companies on the list and the policy goals of the United States and restricting trade with some of them, that's not going to change.
We're seeing the effect of this already, aren't we, on some companies? We saw a week ago, Sequoia, the big venture capital firm, which is traditionally invested in a lot of Chinese companies like Didi Global. They invested in Alibaba. They invest in ByteDance. They're going to split off their China business into basically a separate sort of entity. I suppose this is really another sign, isn't it, of decoupling between China and the US.
Even though Secretary of the Treasury Yellen recently said in congressional testimony that decoupling would be bad. But for years we've talked about things like a segregated internet or a segregated tech space producing chips for China that are different than the chips produced for other markets around the world. And now this kind of segregation is making its way into industry. So we'll probably see more of that in the future. I mean, it's not entirely new. There's examples of big multinational companies that have pulled out of China either because they couldn't make money or they decided even though they were making money, but the operating environment was too difficult for them, and they sold part or all of their business to local companies. McDonald's comes to mind, right? An operation that used to be entirely owned by headquarters, but about 6 years ago, they sold most of their stake to local operators. So, Chinese operators know the Chinese market best, but we'll probably see more of this segregation going forward.
Now, finally, tell me about John Lee. You mentioned that earlier. The APEC meeting is happening in San Francisco later this year. Hong Kong's a member, so John Lee ought to be able to go to represent Hong Kong. The problem is he's on the blacklist because of the democracy issues in Hong Kong. So, how is this going to be resolved? Do you think the US side will remove him from the blacklist and allow him to attend? Or give an exemption,
politically
maybe?
Very difficult. There'd be a huge amount of anger in Congress from both Republicans and Democrats. We now have a very active Hong Kong advocacy NGO community in Washington, D.C., as there is in London and some other capitals around the world as well. So they would certainly advocate strongly against that. But on the other hand, when you take on, when you volunteer to host, you're supposed to be open to everyone attending, with one exception, which is traditionally there's a stand-in for the president from Taiwan at the APEC meeting, so the president never gets to attend. But you're supposed to welcome everybody else. So they're really caught in the middle, but extremely difficult politically to allow him to attend because there'll be enormous criticism. The safest face-saving way out here would be if Chief Executive Lee announces that he has a prior engagement that week.
Some urgent ironing to do or something like that.
There you go.
All right, Ross, great to hear your thoughts there. Thank you very much indeed. That's Ross Feingold, who's Business Development Director at SafePro Group over in Taipei. Thank you for listening to Money Talk this morning. You can find more business and finance information from around Asia in my daily newsletter, which is at peterlewismoneytalk.substack.com. On tomorrow's programme, I'm joined by Francis Lun, who is the CEO of Securities, and Tim Huxley, who's chairman of Mandarin Shipping, and with a view from Australia is Toby Lawson, director at Staten Advice. See you tomorrow.
Money Talk